What is going on, guys? It is finally here. I'm going to go over how to basically work and build my DCF model that I've used in all my videos. A ton of you guys, way more than I really thought, were asking, if you could get your hands on this. And it was an overwhelming amount of people wanting me to do a video on this. I really didn't think it would be that popular. I didn't think too many people would request this. So, hey, here it is. Quickly, if you do want some commission-free trades on Questrade or some free stocks on Wealthsimple, two platforms that I both personally use and stand behind, links to sign up will be in the description or pinned comment. Also, come join the Facebook group where we talk Canadian stocks and a bunch of other nonsense. Link to join that will also be in the description and pinned comment. But without any further ado, let's get into it. There's a couple things I do want to go over first. So if you go down to the description, there's going to be a link to download the Excel file of this model, but there's a catch, guys. There's going to be a password to actually download it, okay? And that password is going to be located at some point throughout this video. So you're going to have to watch the entire thing just to find it. You can't just click out of this video, go to the description, exit out, and fuck me over in the YouTube algorithm by giving me 30 seconds of watch time. You're going to have to find that password first. And if any of you guys post in the comments you try and make it easier for other guys, you find that password and you post it, I'm deleting your comment and reporting you. You trying to help out? Have fun being blocked, buddy. Nah, I'm just kidding. There's no password. Come on. Who the hell do you think I am? Go ahead and download it. But I really do encourage you to actually kind of watch this video and see how this works. It is a very, very, very simplified DCF model, and it does have its limitations. And if you did want to make any tweaks to this, you're going to need to know roughly how it works. So I encourage you to stick around and watch a bit of this, even just throw it on 1.5, 2 speed, and just kind of briefly go through it and make sure that you know exactly what I did to make this. So that if you want to make some tweaks, you can, because there are some subtle little things that I believe you might miss if you don't know what exactly I did here. Unless you're whiz at Excel, you can probably figure it out. But that's really it. So let's get into it. Quickly, actually, before we do, there's a pretty well-known channel on YouTube that basically offers this exact same very simplified DCF model, but they charge $30 a month for you to get into their Patreon to get access to it. Just know that it's basically the exact same thing as this here, and I'm giving this to you guys for free. I don't ask anything in return. Maybe smash the like button, maybe share this. That's about it. But without any further ado, let's get into it. Okay, so basically the first thing that needs to be inputted is you'll take your stock info and you'll put it in right up here in this box. And if you guys want to basically build your own, you don't want to download it, you don't want to potentially, risk anything. You just want to build your own, you want to do it your way. That's totally fine. I'll kind of walk you through how to do this yourself. And in doing so, I'll also explain basically how it works. So basically what I did up here is stock info inputted. Ticker symbol doesn't matter. That does not link to anything. It doesn't have to be there. I just like to put it there for reference. The price does matter because the price is basically linked to these, and these are color coordinated so that if the buy target comes out below that price, this turns red, so it looks like it's not a buy. And if its price right now is below this buy target, it'll be green. So it's literally completely unnecessary, but style points, right? Because style counts. I've got the FX rate up here. This wouldn't apply for if you're doing US stocks. But if you're doing Canadian stocks where the balance sheet is listed in US dollars or something like that, you might want to take this FX rate and take your price here and just multiply this by the FX rate. Just so that's in Canadian dollars instead of US. But in this case, the ticker and the financials are all in Canadian dollars, so that's not necessary. This is just up here, just for reference. If I was doing something like LS Lightspeed, is in US dollars, the financial statements, but the ticker is in Canadian dollars, obviously. So that's where you would kind of link that FX rate in there. So then basically I have two rows of assumptions. My low assumptions, which I believe to be my worst case scenario, and then my high assumptions, which I believe to be a more aggressive best case scenario. Still, I like to make these high assumptions fairly conservative, but this is really up to you guys. This doesn't really matter. These are just the inputs that will actually affect your buy targets. But that's on you guys. That's not me. I'm just showing you guys how to make this model. This is completely your discretion. So basically, what happens here is here's my actual discounted cash flows. And you can see what I mean by they're very, very simple. It's really just revenue and then a free cash flow percentage of revenue given basically your free cash flow margins and then discounted with a discount rate back to the present. And I'll walk you through how to do all this, but it isn't very complicated. And I'll explain where exactly some of the issues will come in this discounted cash flow model. So definitely pay attention to that because it's really, really important. let me kind of go through this first and then I'll address it really soon, like within a minute. So basically your assumptions and then your rate of return, which is going to play into your, basically your discount rate, which is going to affect your discounted cash flows right here. But that's all you need up here. There's not really much formulas up here. Basically these buy targets are being pulled from down here. You can see they're the exact same numbers. So you don't really have to copy anything from here. The implied market caps right here are basically the terminal multiples being pulled. But the main thing, all the work goes on down here. This is the calculator. These are basically just assumptions, which produce this. So let's talk about these discounted cash flows though. So basically what you'll do is, and I've highlighted this just to kind of make it simple. So if you want to download it, it's in a very kind of consumable, easy format. These gray boxes, these are the only things you're going to input any data into. And then this all basically does itself based off links up to here. So basically you'll take these from the company's financial statements. You can use, any website. Yahoo Finance I typically use because it's nice and easy. It pulls directly from Morningstar, so I can trust most of its data. But what I do recommend you to do is don't just pull, the revenue numbers and the shares outstanding numbers. Go to the recent financial statements and just confirm that your number's correct. Use multiple sources to make sure you're using the actual correct numbers here and there's no errors. But basically go to Yahoo Finance and make sure you're doing this. Make sure you're going to the quarterly statements on the income statement, not annual. Because what annual will do is it'll give you your shares outstanding number, but it'll give you that shares outstanding number as of the prior year end. So what quarterly does is it gives you the most recent data. So you want to make sure you're using the most recent data. So go to quarterly. You're going to basically take the revenue, copy that, bring it over, paste it in here. I've already got it in here. And then paste it in this one down here, which this one up here is your low assumptions, which these all feed into and produces it here. The second one down here is your high assumptions, which these all feed into and produces it down here. So you'll take your revenue, copy it from Yahoo Finance or wherever, paste it here, and then you'll go also back, you scroll down and you'll get your basic average, sorry, not your basic. This is a key thing I want you guys to do. Don't use basic average shares, use diluted average shares. Basically what diluted average shares are is it assumes that all convertible shares, basically warrants, employee stock options, things like that, convertible debt, it assumes a really conservative scenario where they're all exercised. So your maximum, you're diluted to the max. So it's a conservative method or measure just to basically use that diluted average shares outstanding. So, and then paste that in here. Paste that there. And that's basically all your inputs. And I'll walk you through how to make this and basically how it works step by step. Actually, no, I'm not going to do that. I'm just going to show you guys the formulas in each one. So basically those are your inputs, right? And then this is basically your revenue right here. What this does is it takes, you can see the formula up there. I think it's called an absolute reference, but basically that's pulled from your revenue growth up here. So if I click into that, I'll show you the formula. So it basically pulls the prior year and then 1 plus whatever your assumption was here. And then obviously down here in this one, in your high assumptions, in your high assumptions, the formula would include this one up here. And then you can see basically up here by looking at the formula, just for your own reference, that is basically, like if I go here, it's pulling from this one, the prior year, and then up there, your revenue growth. Nothing complicated, very simple. This is where the issue arises that I was just talking about. And this is the main flaw of this discounted cash flow model. And that's why I would highly recommend don't take this model's word for law. Use other methods of valuing. Just use this as one of the tools in your arsenal for kind of trying to determine a stock's intrinsic value. This is a pretty big flaw of this model. I just use this model because it's very simple. It's easy to explain to people. It's not very complicated and it's presentable. Like I'm putting on a video for you guys. I don't want it to be super chaotic with all these crazy numbers flying around everywhere that nobody can really understand. So the issue is free cash flow as of a percentage of revenue basically takes your revenue numbers up here, which we just walked through, and it multiplies your revenue by your free cash flow assumption. So it basically takes the amount of revenue that you're assuming is going to flow down into free cash flow. One, that's a very broad estimate to make. It doesn't get very nuanced. The real problem that draws from this is that this basically averages out. It's the same rate for all the years. So if you're trying to project 2026 numbers 5 years from now, and you think that it's going to be doing 20% profit margins or 15% in your low case profit or free cash flow margins. You're also assuming those 15% margins next year, which may not be very realistic. Where that can be very problematic is with a stock like Lightspeed. Any stocks that aren't free cash flow positive right now, this is going to be problematic. If you're projecting, 15% free cash flow in 5 years, but the company's losing money right now, this is going to pull this 15% and assume they're free cash flow positive next year, when in reality, it might take them a couple more years to become free cash flow positive. So in this case, if I'm analyzing Lightspeed, I might manually go in here and enter negative 50,000 or whatever I think free cash flow might be to give me a more realistic option. Rather than letting it just pull from up here, I'll manually enter this. And then say we think they're going to break even in 2023, change that to 0. And then they're going to work up to about, 60 million in free cash flow. These are all in thousands, by the way. I have that right there. I just made it simple. So these are basically 700 million, not 700,000. And basically I'd have it, increase like that. And another way you could do this is by saying, look, I think they're going to do negative 10% margins this year. I think they're going to be break even in 2023, so 0. I think they'd be doing 10% margins the year after, then 15%. And then I think they're going to stabilize around that and slowly increase after that. I would create a range like that and then calculate the average. Oh, whoops. So do an average formula. So that's telling me 6.2 will be my average. Then I would come up here and plug in 6.2 right there. That's what I would do. And that's a really conservative measure to go about doing this. Let me kind of backtrack. Let's get back to where we were. And the same thing for revenue too, because you can typically find management will give guidance on revenue. So this right now is pulling from our assumption up here. But if management has told us that, say next year, we think that management says this company is going to do 900,000 in revenue, I'd be conservative with this, but I would take their word for it and go 900,000. Enter that in manually. These ones are still going to pull from basically here, pull from our assumption. But now this one's more accurate with what management and, say, analysts believe revenue is going to be in the next 12 months. Just kind of making your projections a little more, just as accurate as possible, right? But let's go back. So basically the formula for these, it's all the same. It's this times your free cash flow margin. Next, we have your discounted cash flows. This is basically where the magic is. And actually, wait, let me talk about the terminal multiple first. So basically, what's going on here is you have your discounted cash flows, your free cash flow percentages of revenue. What you want to do in the final year is you want to calculate your terminal multiple, or your terminal value, basically. What that is, it's your projected market cap, what you think the company is going to be worth based on your assumptions in 5 years, or however many years are in your model. So basically what you'll do is, this formula is your final year's free cash flow times your multiple here, your price to free cash flow. And that's basically your terminal multiple that's going to be used to calculate your terminal value in the year that you plan on selling the stock. And then you'll see how that plays in. But that basically, your terminal value is your implied market cap, which is up here. Next, we have your discounted cash flows. That's what the whole thing is, right? That's where the magic happens. You can see the formula up there. What it does is it pulls from this free cash flow percentage of revenue, and then divides that by 1 plus your discount rate, which is up here. That's essentially what it does. If you guys, I don't want to really explain what the present value formula is, but this is basically your present value formula. It calculates the present value of a number. What it's going to do is going to divide the basically free cash flow by 1 plus your discount rate to the power of the year that this is. So this is year 1, right? So I have 1 up here. I hid the number, but you can see it's up there. It's 1. You can see right here, if I scroll to this one, it's going to be 2, 3, 4, 5. What I did is I kind of I formatted these because I wanted to make this pretty, right? So I went up here, went to number, custom, and then instead of general, basically what you'll do, highlighting all these. So here, let me actually show an example. So if I have right here 1, 2, 3, 4, 5, and then 5 up here as well, is what I would have. Because you can see that terminal is being discounted by 5 as well. That's 5. What I would do to make these disappear just for your guys' reference, if you want to do the same thing, you want to clean things up, go up here to number. Go here to custom, here, and then type in 2 semicolons. Oops, 2 semicolons, then okay. And now they're gone. But they're there. They're just hidden. So let's get rid of those, delete those. But basically that's what it's doing for every single year. It's discounting your cash flows up here. It's discounting these to the present day. Because obviously future cash flows, if you know anything about discounting, future cash flows due to inflation are worth much less than they are today, right? And due to the compounding power of money. So money today is worth a lot more than money 5 years from now. And you can see that here. Basically what these all do is they're all discounted by our discount rates to the power of the year. So this would be to year 5 up here. Then what we do is our terminal value that we've calculated, we also discount that by the 5th year. If this was 7 years, this would be the terminal value would be discounted by to the power of 7 instead of 5. But if you're making this yourself, you can kind of copy that formula. And then I basically have totals here, which are kind of the total of all that. And then we have the shares outstanding, which we inputted. Remember, we went with the dilutive. This basically, the formula pulls our prior year number and then times it by 1 plus whatever we think shares are going to increase or decrease by. If we think they're going to be buying back shares, we'll change this to negative whatever, -1, -2, -3. I'm assuming they're going to issue shares, so I'm keeping it 4%. But if we think they're buying back, it would be, say, -4%. And then that formula is going to be the same for every single one. And then this will be pulled from your final year number. Basically what this is your terminal multiple. Basically what a stock is in general is the present value of all future cash flows. But these future cash flows include the cash inflow that you're going to receive when you sell the stock at your desired date. So we're saying 5 years from now, we're going to sell this. And this is what the company is going to be worth right here. This is what it's worth in today's money. But what's basically going to happen is we're also going to discount this and then divide it by the shares outstanding. And then that's where we come to this line here, free cash flow per share. It basically tells you the free cash flow that you're receiving. They take the entire sum of free cash flows produced by the company, divide it by the shares outstanding, basically indicating the percent or basically the piece of the free cash flow of the company that you're entitled to with your share. So this is your free cash flow per share. And this is basically this composes what your share price is. Your share price is right here. It's the sum of all the free cash flows you receive per year. It's the sum of your present value of future cash flows, which also includes your share of that exit price. So basically what the company's worth in today's dollars 5 years from now, divided by the shares outstanding, that's your chunk of the company in 5 years. That's included when you sell your share. So it's basically the sum of all of these gives you your share price. That's what your share price is. Sum of all future cash flows plus your exit in 5 years or whenever your terminal is. It's the exact same thing for this one down here. I kind of just made it pretty. Again, if you want to just download this, go for it. But these are basically the same thing. They're just pulling from your high assumptions up here. And then so basically that's your share price. That's what's pulled up here. And I'll walk you through quickly, lastly, how I kind of formatted this, how I color coordinated it. So let's just assume we'll put that at 130 just for reference so we can see one's green, one's red. Okay, we'll pretend it's up here. So we'll say this is 1 and this is 200. So if we want to format these guys, basically what we'll do is we'll go to this 200 one. We'll go up here to conditional formatting under styles. And we'll go to new rule to set a new rule. Basically what we'll do is we'll click format only cells that contain and the cell value, and we're going to say greater than or equal to. And then right here, we're going to click our share price. So if this number right here is greater than or equal to the share price, this format will happen. We're going to go to format and we're going to just go more colors. I think I went with this one here because I like that color. And then okay. And now you can see it's green because this is higher than that. If we turn this to 100, now it's not green anymore. So if we want to turn it to red, I should have done this for both of them, but whatever, we'll get rid of that. If we want to turn it to red, we make a new rule. We go to the same way, we go to format only cells that contain, and then cell value less than, we'll go less than this time. and then the share price. So basically, if this is less than this, we're going to click format and we're going to make it red. We're going to go there. There you go. And now it's less than that, so it's red. If it's more, we'll do it to 300. It's green. So cool little thing there. We'll get rid of that though. But yeah, this is basically the model. Like I said, you guys can download it. Hopefully you saw all the formulas in there, and if you wanted to build it yourself, you can go about doing that. Yeah, final words of caution. Final words of caution. Again, do not take this thing's advice for law. Use multiple different ways to calculate the intrinsic value. Like I said, this should be one of the tools in your arsenal in terms of doing that. One thing I highly recommend doing is find other YouTubers, find other people that you really trust. Look at their numbers, look at their assumptions, and compare your numbers to theirs. See how far you're off, see what you might have done different from them, and then consider their factors as well. Lastly, I also want to talk about this implied market cap pretty quickly, and actually just things up here, basically. Let's talk about this. So basically, these are your assumptions. I talked about that. They all pull from that. Your years don't really matter. These aren't connected to anything. I just kind of put that in here for showman's sake. Desired return, why did I go 15%? I always go 15% because, look, the S&P 500 averages between 8 to 10% per year. If you're going to take on the actual risk of buying an individual stock rather than a safe index fund, reward yourself. Give yourself that little bit of a margin of safety, just in case your assumptions up here do go wrong. That's going to impact your return. So make sure I always go minimum 15%. The minimum I'd say ever do is 12%, but I like to go 15. Your implied market cap is basically your terminal multiples down here, which I talked about earlier. Your terminal values. I keep calling them multiples. That's your terminal multiple. What this tells me and why I like to have this up here, if I'm analyzing a stock like Apple, for example, and all my assumptions have it coming out to a $12 trillion stock, I'm going to say, hold on a minute, 12 trillion doesn't seem very realistic. Let me go back, reassess my assumptions, and see what I did wrong. Because 12 trillion is like a third of the US GDP, probably more than that. I don't think that's very realistic. That's why I kind of like to have that up here. And again, these are in thousands, so that's not 1 million, that's 1.7 billion. Yeah, so basically that's it, guys. Appreciate you guys for watching. If you have any comments, questions, any criticisms, anything you would do to make this a little better, anything I can add to this, definitely let me know. I'm always, I'm not above improvement. I actually really welcome it. If you guys, know a way to make this a little better, a little more clean, if anything, let me know. Let me know in the comments. Appreciate you guys watching. And, hey, we'll see you next time. And take care, guys.